What is central bank operational independence? Imagine a central bank as the engine of a country's economy, steering interest rates and money supply. But who gets to decide how it runs? That's where operational independence comes in. It means the central bank can make daily decisions about things like setting interest rates, controlling inflation, and managing the money supply without direct interference from politicians or government officials. This independence helps the bank focus on long-term goals like price stability, rather than short-term political wins. This idea started gaining traction in the early 1900s, especially after World War I. Countries saw that governments often used central banks to fund deficits or boost the economy for political reasons. But this often led to high inflation and economic chaos. So, many nations began to realize that keeping the central bank separate from political pressure could lead to better economic results. Operational independence is different from broader independence, which also includes the bank's ability to choose its overall goals. Here, the government might set a target for inflation, but the central bank decides how to reach that target. It chooses the tools and timing, like adjusting interest rates or controlling how much money is in circulation. This separation builds trust because people believe the bank makes decisions based on economic facts, not politics. A key moment in this history was the 1951 Accord in the United States, which made the Federal Reserve independent from the Treasury Department. Later, many countries followed suit in the 1980s and 1990s, giving their central banks more legal independence to fight inflation and stabilize their economies. The European Central Bank, created in 1998, was designed to be independent from political influence too. Legal rules often support operational independence, clearly defining what the central bank can and cannot do. These laws help protect the bank from political pressure, ensuring it can focus on its main job, keeping prices stable. Public trust is also vital. When people believe the central bank is making decisions based on economic health, it influences expectations and makes policies more effective. In practice, operational independence allows central banks to respond quickly to economic changes, like raising interest rates to fight inflation or lowering them during a recession. It also helps them manage financial crises with a focus on stability rather than political considerations. However, this independence isn't absolute. Central banks still answer to the public and government through transparency and regular reports, which keep them accountable. Looking at history, the move toward operational independence shows a shift from political control to a more professional, expert-led approach to managing money. It's a way to protect economies from the risks of political meddling, like inflation or instability, and to promote steady growth over time.